Today's session on banking from the Community Financial Empowerment Certification Program will be recorded so that it can be used in an online database that people can access. If you do have any issues with that, please drop them in the chat or mention that to me. Otherwise, let's go through some logistics. For those who do not know me, my name is Joseph Cecil, and I'm the Financial Empowerment Coordinator for the Office of Resilience and Community Services. One of the programs as part of that position I get to coordinate is the Community Financial Empowerment Certification Program. So if you have any questions, comments, or concerns about that program, my contact information will be available at the end. If you have not already, please mute yourself. You are welcome to unmute during the class for questions, comments, or concerns. But unless you have any, please, for the time being, mute yourself. If you have not already, please type your name in the chat as a form of a sign-in. If I cannot find your name in the chat, I cannot give you credit for attending today's session. Also, we are scheduled from 10 a.m. to noon. That's always a more generous time frame than normal. So with that said, let us go ahead and get started. So what are the two main types of financial institutions? There are bank and they are credit union. Can anyone guess what the largest bank in the United States is? Any guesses? The largest bank in the United States. It's actually the largest in the world. Any guesses?
U.S. Bank?
I got a U.S., I got a Wells Fargo. Those are both incorrect, unfortunately.
Bank of America?
Not Bank of America. The answer? J.P. Morgan Chase. J.P. Morgan Chase has over $2.62 trillion in assets. Can anyone guess the largest credit union in the United States? I'll give you a hint. Lynette guessed the U.S. government for the bank. You're along the right track for the largest credit union.
I was going to say teachers.
It is not teachers. Lynette is getting closer. She says military. It is the Navy Federal Credit Union. They have $111 billion in assets. So can anyone tell me what the main difference is between a bank and a credit union? They have small differences, but there's one huge difference between the two. Anyone know what it is or any guesses? Well, the difference is, at the end of the day, a bank is a for-profit business. When you purchase something there, you're a customer. And as Lynette said in the chat, a credit union is legally a 501c3, which means it's a community nonprofit organization where when you get a product or service there, you're a member of that credit union. At most credit unions, this technically means you own a very small portion of it. So which one do you think we are headed to for a lower interest rate and an overall lower cost on a loan or a mortgage? A bank or a credit union? What do you all think? Yep, the votes are coming in. Credit union is right. Where are we headed to for more products and more offerings? Bank or credit union? Answers are coming in. Bank is right. Where are we headed to for more branches and more ATMs? Yeah, bank is still right. And where are we going for more localized service and better customer service? Credit unions. Good job. So what you're going to see is when you have the advantages and disadvantages of each type, they tend to play off each other. So the advantages of a bank, as we just mentioned, are they got more of everything, more ATMs and more branches, more products and more services because they have more money. If I ask people to start naming people on the street to start naming financial institutions off the top of their head, the majority are going to name banks because they're the ones we see more. They advertise, they have more money. So that means the disadvantages of going with a credit union are, well, the first is they may require certain characteristics to be a member. This is not in all of them. But for instance, I used the Navy Federal Credit Union earlier. In order to qualify for membership at the Navy Federal Credit Union, you or a family member had to have been in the Navy. There aren't many of those credit unions, but there are some that do require certain characteristics to be a member. In terms of the disadvantages playing off the advantages and so forth, well, the problems with a credit union are smaller. They have less branches and less ATMs. And this even means where they're located. So if you did not know already, most credit unions only operate, as in terms of branches and ATMs, in the counties they exist in. They don't have branches and ATMs outside of that county or that city. That doesn't mean that people's debit cards and credit cards can't still be used outside of that city and county. It just means you will not find a physical location outside of that county or city. They are, though, partnering with bigger banks, so you can use their ATMs. And there are also, many credit unions have a reimbursing fees policy if you have to use an ATM outside their network. And again, they're going to offer less products and services because they don't have the resources of a bank. Some of them do also tend to lack the technological resources and products that banks tend to offer. They do tend to be a little behind the curve. So then why would we go with a credit union? Well, they tend to handle customer service better because of that smaller size. Everything is located in that city or county. In fact, a 2017 American Customer Satisfaction Survey showed that customers rated credit unions with a higher satisfaction score than banks, scoring 82 out of 100. They're also most likely going to offer better interest rates, both in terms of loans where you want it lower and savings account interest rates where you want it higher. They have less fees, and those fees they do have tend to cost less. They also tend to have less requirements in terms of opening and maintaining accounts. So then that means the disadvantages of going with a bank are customer service can be a little bit harder to resolve. Where does a bank normally send someone with a customer service issue? Whoa, what do they tell them to do? What do you all think? Where does a bank normally send someone with a customer service issue? All right, I got one comment says go online. That's one option. The 1-800 number on the back of that card, right? Yep, you guys are nailing it. And is that person normally located, do you think, in the same city or state as you? Most often not, right? Sometimes it's not even in the same country. And that's not a problem, but it can be harder to get something fixed. But just know this, even if the customer service at a larger bank seems cold or robotic, it's often done that way due to make it consistent. Because there's a big problem with teller turnover, and also to keep things uniform. So a lot of tellers are come and go at banks, and that's why they may not be able to answer your question that easy. But at the call center, they've got a computer in front of them; they can pull up everything they need. Also, being a for-profit institution, you're likely going to see those interest rates that are worse off for you. And they're generally more fees, and they're going to cost you more. And here's a handy-dandy little chart just to help outline all this. And at the end of this presentation today, I will send this presentation out, so you will get a copy of it. But one thing I like to mention when working with clients around banking is, as much as I just made everything look like credit union versus bank, and this graphic even says so, it's not. It's bank or credit union, whichever one fits your needs the best. There's no law that says we can't have an account with both types to get the best of both worlds. But the last thing we want to do is have two separate accounts at different institutions and struggle to keep them open. So we have many different types of banks and financial institutions. Retail banks are probably the ones we're most familiar with. Those are the ones that focus on us as the general public as customers. Commercial banks, well, they focus on businesses because businesses need different services, more complex and unique services, and dollar amounts that tend to be much larger than the general public. They might need to accept payments from customers, rely more on credit, or need some kind of endorsement to do business overseas. There are also investment banks. They help businesses work in markets. If a business wants to go public, they'll often use an investment bank. Investment banks focus on providing corporate clients with underwriting and assisting with mergers and acquisition. Morgan Stanley and Goldman Sachs, I'm sure we've heard of these two titans of the financial world. Well, they're investment banks. Central banks, they manage the monetary system for a government or a country. For example, the Federal Reserve Bank is the U.S. central bank. Then you've got community banks. These are typically locally owned and operated. They tend to focus on the needs of the community where they're located. Lending decisions are often made by people who understand the local needs of families, businesses, and farmers. Most agencies base the term community bank on the size of the assets they hold. So I don't know if you noticed this, but between 1984 and 2011, more than 15,000 banks exited the industry. About one half of those merged with another institution. Bank branches have been steadily closing. The FDIC reported nearly 5,000 closures between 2009 and 2014. Our financial relationships and access to financial products are increasingly occurring online or through an unfamiliar agent on a customer service line. So now we're going to play a game called Name That Institution. I'm going to give you some hints, see if y'all can guess it. It was founded in 1858. Its headquarters are Cincinnati, Ohio, and it's got 1,154 branches across these states. What institution do you think this is? I got one guess for Fifth Third. What do y'all think? I got BOA, Bank of America. Any other guesses? Those are the main two right now, it looks like. Well, Debbie is correct. This is Fifth Third Bank. Our next one was founded in 1845, headquartered in Pittsburgh, Pennsylvania, and has 2,481 branches across these states. Which one is it? Headquartered in Pittsburgh and has this branches across this geographic area. We got U.S. Bank as a guess. We got Bank of America. No one's got it right yet. It is not Bank of America or U.S. Bank. Lynette got PNC, Lynette and Sarah, PNC, Pittsburgh National Corporation, PNC Bank. Our next one was founded in 1872, headquartered in Winston-Salem, North Carolina, has 1,800 branches across this footprint. Any guesses before I give you a hint? We got Wells Fargo. Unfortunately, that's incorrect. Any other guesses? Not U.S. Bank. Your hint is they are currently merging with SunTrust. This is the former BB&T Bank. Now Truist. BB&T and SunTrust are merging, and it is Truist now. This one was founded in 1954, headquartered in Louisville, Kentucky, and has 19 branches across Kentucky and southern Indiana. Which one is this? Not Stockyards, not Republic, not West Banco. You guys are all hitting on good ones, but it's neither of those. You've got a hint in the photo. And that would be L&N Federal Credit Union, the Louisville and Nashville Federal Credit Union. Last one, founded in 1982, headquartered in Louisville, Kentucky, has 38 branches across these 5 states, and they sponsor a ton of activities and events in Louisville around Derby time. That is Republic. We got a couple guesses already. Republic Bank is correct. So just some simple reasons. Why do we need a bank account? Well, we need a secure place to keep our money. Accessing other products, starting that relationship to build assets and access credit. It's a great alternative to those high-cost products and services to access our paychecks. On average, someone without a bank account will spend $800 per year on fees accessing their paycheck. So what is important to consider when picking a financial institution? What about the locations and hours? That's got to be workable for you. Do they have a lot of ATMs if you're on the go a lot? What kind of products and services do they offer? What do the fees look like? And what's their track record? Some people look beyond just their financial track record. How have they acted socially? So what do we need to open an account? Well, we're gonna need proof of identity. And in today's world, a lot of institutions are requiring 2 forms of ID to open an account. These would be things like a driver's license, a state ID, a passport, or a consular ID for those people who have immigrated to the United States. You're going to need proof of address, and you're going to need your minimum opening deposit. And at a lot of places, you're going to need no negative track record at a previous institution. So if you've got someone who's starting to look at maybe getting a bank account or a new one, these next 2 slides have got the comparisons. You can print these out and use these as a comparison shopping chart. These are the logistical questions. Where's it located? What are the hours? How many forms of ID do I need? On the next page, these are the accounts questions. These are the ones we usually don't ask. And then we sign on and wonder where our money went when we get hit with fees. Sarcastically, my favorite one of these is the minimum account balance fee. At a lot of places that says if I drop below $10, you can hit me with a fee above $10, and I don't know how that makes sense. That just doesn't make sense to me. So let's look at using a bank account. And one thing we're not going to do here is go over everything word for word. A lot of what I'm going to hit on are the modern changes happening in the financial world. So the main difference in a checking and savings account, well, a checking account is meant for your everyday transactions. Money's supposed to go in and come out. Savings account, well, it's in the name. It's meant to be stored there over time. That's why there's interest on a savings account. It's meant to incentivize you to keep that money saved. They do have higher interest rates, and most checking accounts won't have any interest rate at all because, again, money's supposed to come and go. Also, please know when it comes to savings accounts, some credit unions may not issue a debit card to a savings account. You may just get a membership card, which means if you want to access or utilize money from that account, you have to go to a physical location. Please know prepaid cards are not debit cards. It's not linked to an account at a financial institution. And most of the time, you're just going to be using money that's loaded onto the card in advance. You have 2 different types. There's open loop cards where they're accepted wherever that logo is accepted, or it's closed loop where it's only allowed to be used at certain locations. Many employers are using these cards as easier methods of payment, but these products tend to nickel and dime their employees out of their pay. Some charge you each and every time you use your PIN. Think about how many times in your daily life you use your debit card and you use your PIN. And on a prepaid card, every time you'd be getting a fee or a charge. There's limited ATM usage, and there can be fees around just asking for how much money is on the card. Bill payment, ATM use. These things have actually been rated as predatory products because of how much they nickel and dime the users. So deposits, we all know it's how we get money into our account. We got 4 main types. Direct deposit, it's where our employer does it for us. We've all done manual deposits in a branch. ATM deposit is what it sounds like. The one I want to hit on is the newest one, the mobile deposit. Saves us a ton of time and convenience, right? Just opening up the app on our phone and taking a picture front and back of a check. It's extremely convenient, but is it unsafe? So we have one small safety concern over using mobile deposit. Can anyone guess what that small safety concern is? Any guesses on what the small safety concern is around mobile deposits? So let me see here. We got a few guesses here, and I'll address them one by one. Your account number is in your photos. So that is a good question. When you take the photo of the check, please know this. It is not stored in your phone. The camera is in the app you're using. So the information just stays in the bank app. It does not go to your phone. So you do not have to worry about deleting photos from your phone. The check is floating out there. We're going to talk about that as one small issue, is that you still have to take care of the check. Someone hacking your account, that is a common concern. Please know this, though. Most financial institution apps are probably the safest, most secure apps on your phone. They're the most well protected because they know they're big time targets. May hit to the wrong account. That's a big one. So you all danced around very good issues, very good things to think about. But like I said, it was a small security concern, and literally it's nothing more than this. You got to be safe about that check. You still hold a check. Until that check is posted, you've got to keep it valid and safe. And when it's done, you got to protect it and then dispose of it properly. That's our only small concern, is you're now taking that little bit extra risk and responsibility of now holding that check till it gets into your account and then disposing of it properly. That's it. It's not a big concern. When are the funds available? Well, cash is same day, if not instant. Most checks, the key phrase is, it takes 1 to 2 business days when the bank is open and consider themselves open for business. A question to ask at your bank or credit union is, many of them are open on Saturday mornings for a couple hours. Some of them may count that as a business day and some may not. And that can make a world of difference if you deposit something Friday and for sure need it in that account Monday. Also know that with mobile deposit, a lot of institutions are now offering a small fee to access that money sooner. So just know that if you or someone you're working with has that option, that they will take a fee out of that check if you want it sooner. So here's a sample check. What's wrong with this? Is this good to go? There's nothing wrong with this, right? Anybody see an issue? Well, it's no dated and no signature. That's good catch, but there's something else wrong with it. Sarah kind of hit on it, the wording. So I've got it written out for 250, but in the numerical sign here, it's 2,500. If you turn this in, which one is your bank going to accept? Is it going to take the written out or the number box? Oh, you all seem pretty convinced it's the written out. Ooh, some people said the number. Well, let's see. Most of the time, actually, now, they're not going to accept the check at all because of the difference. Because people can edit them. People can try to use a little whiteout to turn that 250 into 2,500 in the number box. If they do accept the check, they will always take the written out part because of how hard that is to edit. Someone can take a little bit of whiteout, get rid of that period, and add another couple zeros to make it 2,500. But think how hard it would be to change this 250 to 2,500. You're going to notice. Most of the time, they're going to ask you to get the check rewritten or reissued. But if they do accept it, they will always take the written outline. So checks, unfortunately, they're the antiquated purchasing method. Checks are being phased out as a method of purchasing items. One reason is, well, it's an age demographic thing. A lot of checks are used by the elderly and older population. There's a cost to the consumer now that didn't used to be there. You know, checks used to be easy to order and cheap to get. Now you're looking at $20, $25 to get a batch of checks for something you may never use. A lot of people don't like the time it takes for a check to clear and be taken from your account. You know, it can take 7 to 10 days for a check to fully go out and go through your account. And then we have the security issues of checks. You know, how often they're frauded. Checks are declining at a rate of approximately 2 billion per year. And that rate has remained steady for about a decade. For every day that goes by, annual check volume decreases by over 5 million. And this has been going on for 4,700 consecutive days. So it's pretty fair guess that in our lifetime, checks may cease to exist. Right now, Americans write only about a third as many checks as they did 20 years ago, when check usage hit its all-time high at an estimated 49.5 billion checks in 1995. Right now, there are about 18.3 billion checks paid per year, and that's an average decline of 6.1 billion checks in each recent 3-year period. In an incredible stroke of convenience, the rate takes us to zero right on the nose in 3 reporting cycles, which would be the 2022 report. Now, I don't think checks are completely out as of this year, so I think the trend's a little bit off. So what are people still using checks for? Well, the majority is still consumers paying businesses, as you can see here on this chart. What are people using then? Oh, I'm sorry. Well, as you see here, in the most recent reporting year here, the most recent data year, checks that slipped from 46% of the type used in 2003 to just 15. Unsurprisingly, the number one type used, debit cards, followed by credit cards. So, question to the group. How do we properly dispose of a check? Maybe one that's gone through mobile deposit or one that we messed up writing. There are 2 steps. How do we properly dispose of a check? Okay, we got 1 step, that's shred. That's correct. We got to do something before the shred, though. Right, void. Void and shred. Good job. Void and shred. And we're going to add extra layers to it, extra steps. Void, and preferably in a permanent ink like a Sharpie. Always use permanent ink. There's sadly examples and instances of people piecing together checks and bleeding them of regular pen ink. But a Sharpie will always leave something behind. We got shred, tear up, or, I've even heard burn. One of my coworkers, she does that, and she says you can't tape ash back together. He's not wrong. Your extra step on the shred and tear up, take the remains of the check and put it in separate trash bags. Make it that little bit harder to piece it back together. And anyone ever seen this movie, Catch Me If You Can? Leonardo DiCaprio and Tom Hanks. Well, I use this as an example because this was one of the nation's most significant check fraud artists, and he was doing this back in the 60s. And I think we would all agree technology's gotten a little bit better since then. We live in 2021. So, take that extra step to protect yourself. You never know who's out there trying to get your information. So we've got a sample debit card here. We'll go ahead and hit on it. What is number 8 here? What is this number 8 on the back of the card? And what's that code used for? It's the security code. You guys got it. What's the security code used for? Where do we use it? Where do we use that 3-digit number? Online or over the phone? Yes, good call, everybody. If we use it online over the phone, it's become our second most important financial number behind our PIN. Because when you pay for something online or over the phone, they usually don't ask for your PIN. They ask for the security code. So PIN, does anyone know what that stands for? We got personal ID number. Yep. Don't be like me and you'll say PIN number because then you're just repeating number twice. Personal identification number. You're actually recommended to change it every 6 to 12 months with the rise of skimmers and hackers. And anyone know why that chip's there now? The chip that's pretty much in every card. Anyone know why that chip is suddenly there? Well, the chip makes sure that a PIN number is used in the transaction most of the time. And also, it turns your card information into a unique code. So before the chips were in the card, your transaction ID number at any business you used your debit card or credit card was the number on the card. So if anyone hacked into that business, They had everyone's debit and credit card numbers. Now, though, it turns your card information into a unique, different code every time you use it. It also makes it very hard to use the card in person if it's lost or dropped on the street. It can also give you time to answer mobile alerts if that card is lost. And some stores and businesses are even recording any transactions where a chipped card is used. So with account statements, real quick, just make sure you're not being charged to receive these. Paper monthly statements may come with a small fee these days. Also, if you do get these in person, please make sure you're disposing of them properly like a check. Just look at all the sensitive information that's on here, your spending habits, address, some bank account information. You've got to make sure you're disposing of these properly. It's your personal information sitting there. So overdraft protection, it's like a safety net. It's almost like a line of credit from your bank or credit union on that bank account. And it's going to allow you to make purchases you need even when you don't have enough money in your account. Usually they agree to extend your account about $50 to $100 for a monthly fee. But you got to pay back that amount you overspent plus fees. The bank may also take the money from a linked account if you have one. It's important to remember that even if your account comes with an overdraft protection feature, you can opt out. And in fact, many Bank On Louisville, the other program I coordinate, recommend people opting out. When you opt out of overdraft protection, your debit card will be declined if you try to use it when you do not have enough funds. One of the reasons we recommend opting out of overdraft protection is, unfortunately, many people who pay for it think, well, I'm already spending the money, I might as well use it, and they will intentionally overdraft their account. Just know that if you do get your card declined outside of overdraft protection, you're not going to have to pay any fees. You'll just simply be unable to make that purchase. So if you get out of overdraft protection, you opt out, there are still 3 ways you can overdraft your account outside of the protection. Any guesses for the big 3 ways, the main 3 ways you can still overdraft an account? See, one guess is using credit. What else? Checks. Checks are a big one. Yep. Let's see how y'all guessed. You can always bounce a check. You can always bounce a check. Maria got the next one. Automatic bill pay is a big one. Think about it. With automatic bill pay, you give a business or vendor the right to access your account on a monthly basis to get their fee. And that computer or that service does not care how much money is in your account. It's been told to reach for a certain amount, and it's going to reach for that amount regardless of how much is in your account. And the last way is the dumbest way. That is paying at the gas pump. So when you use a card at the pump, does not matter how much you pump into your card is charged right then and there, $1, and that's it. It's called the pre-authorization fee. The next day, the gas station will come to your bank for the rest of the amount you pumped. But at that moment in time, you are only charged $1. That makes it easy to overdraft because the rest of that charge hasn't hit. So what happens if the bank fails? Well, the FDIC, the Federal Deposit Insurance Corporation, is there to make sure that's not an issue. They provide insurance of at least $250,000 per account. Every bank has to be able to prove they can provide that insurance to the FDIC. Since the FDIC was established in the aftermath of the Great Depression in 1933, no depositor has lost a penny of FDIC-insured funds due to a bank failure. For the credit unions, they do the same thing. It is the National Credit Union Administration. So mobile and online banking, very convenient and time-saving, allowing you to skip long lines or having to travel. But please remember, if you check your account online, the balance shown there is not a current moving fluctuating balance. It does not show activity in real time, but it can help you get an idea of where you're at. Please be sure to log out. Most apps are timed to 90 seconds of non-use that will automatically log you out. But anything on a desktop or laptop, please log out. You never know who's coming in behind you. Try not to allow your banking app to remember your password. That way, if anyone gets a hold of your phone, it makes it that much harder. And I'm going to make you all sound like celebrities here, so please take it that way. Make appearances in your local branch. Be seen, be recognized. It makes a world of difference if you run into an issue or your client you're working with has an issue or needs to access something else, if they're known and recognized at their local branch. It saves some hassle. It is the future. You know, online and mobile banking. I actually argue it's the present. According to research from Jumio, 76% of baby boomers bank online, where I was very surprised at this. Only 1% more of millennials do at 77. I did a series of classes at a local university with bankers from 4 large regional banks, and I asked each of them to tell the class how long until bank branches no longer existed. And I thought it was a joke. No one answered more than 20 years. A couple even said 10 years was the shortest answer before bank branches no longer exist. So that's part of why I say online and mobile banking. It's not the future. It's here now. It's the present. Especially with this trend has been accelerated by the pandemic, with branches being shut down temporarily. Those reps mentioned that branches will be replaced by larger ATM style machines that can even take credit applications, and customers will be called into an HQ to receive further assistance if necessary. So look for certain things to compare for your online and mobile banking experience. How user-friendly is the site? You know, speed, accuracy, convenience. Can you apply for new products so you don't have to go to the main branch? You should be able to check into their security and protection to know that you're guaranteed. Well, you can't guarantee, but to know how safe you are. You know, look for your range of features. That's a huge thing in online and mobile banking. What can I do while I'm on here? And a huge thing that one of the biggest things is customer service. A good online banking platform should have a live chat during most of their business hours. You don't have to call someone. You should be able to access it within the app. So what are some safety tips for online and mobile banking? The first is find a secure network for your phone. Avoid public Wi-Fi or hotspots. Hackers are known to intercept our information by hopping on to unsecured public networks. You know, choose a strong password. Try not to share login details with anyone else, and don't use numbers that are important to you. You know, social security number, date of birth, things like that. You know, review your statements. Just make sure. You never know what's being charged to your account unless you look. Know that online banking through a computer is less secure than the bank's mobile app. And it's a fancy term, but look for two-factor authentication in your financial apps. This just means a secondary password. It's a second layer of security, asking for a second method to verify who you are. The main two options here are on these newer smartphones, the biometrics, you know, like the eye scanner or the fingerprint. And also, one of my favorites, just a verbal password. That means anytime you're in person at the bank or calling, they're going to ask you, what's your verbal password? And that is one of the best security features. Because if you don't tell anyone else, how's the hacker supposed to know? And make it as fun and dumb as you want to. I think one of the ones I used way back in the day was waffles, just because it was fun to say. Just a hint, that's not my current one. You know, put some thought into your PIN and passwords. Again, avoid using any form of your date of birth, social security number, or phone number. Those are easy to use, but also make it easy to be hacked. Don't keep it written down anywhere. Look for those password manager apps that are offered. For your online passwords, try not to use the same one twice, as tempting as it may be. That way, if one is compromised, the rest of your accounts won't be. Here's a big thing going on now. If your bank calls you, Call them back. Do not answer. If you receive a phone call from your bank or someone saying they're from your bank, do not give out any sensitive information. If the number on the caller ID seems to be from your bank, there's a new tactic out there called spoofing and mimicking, where someone can seem like they're calling from a legitimate number. You should web search the number or email that reached out to you and contact that number you find on the internet. That way you're actually calling the bank. You can ask them, did someone just contact me? This is a big one too right now with the IRS scam. I'm sure some of you have heard of this, where the IRS is calling people. Please know this and spread this information. The IRS does not call people. The IRS communicates via mail. So if you get a call from someone saying they're from the IRS, that's 99% bogus. There are some financial institutions in our world today that only exist in the online and mobile realm. They're called direct banks. Ally Bank is probably the biggest and most well-known. Discover also runs an institution that's directly online or through the mobile world. There's also Access Bank. The pros of these are they have better rates and lower fees because they have less overhead costs. They don't have physical locations. They tend to have better tech and online experience because they have to. That's where they exist. Well, the cons are you got an absence of ATMs and physical locations, and you got that less personal relationship. So any questions on actual banking, like physical banking actions and things like that before we move on to banking issues? Any questions, comments, or concerns? Second. Also check to make sure anyone new is logged in. Just a reminder, if you logged in after we got started, please drop your name in the chat as a form of a sign-in sheet. Otherwise, I cannot give you credit. All right, seeing no questions, we will move on with banking issues. Close to 7% of households, approximately 14 million adults, are unbanked without a savings or checking account of any kind. Almost 20%, or 50 million, are underbanked, meaning they still use some form of fringe financial service. Underbanked refers to families that prefer to manage their finances through cash instead of more traditional financial services like those accounts. By definition, at least twice a month, they still use an alternative service like a payday lender or a check casher. Nearly 37% of unbanked and 45% of underbanked households earn less than $30,000 per year. Nationally, more than half of African American households and 46% of Hispanic households are unbanked or underbanked, compared to less than 20% of Caucasian households. So unbanked individuals are only half as likely to be able to come up with $400 as the rest. They only have 5% of the savings as everybody else. On average, their credit scores are 33% lower, and they're less than half as likely to be able to increase their savings. They're 33% less likely to be able to improve their credit scores. However, those who became banked were 8 times more likely to save the amount of at least one paycheck and are more likely to improve their credit scores. Recent studies have confirmed that steady jobs with biweekly paychecks are scarce in low and moderate income communities. Instead, these households rely on unpredictable part-time and seasonal work, often having to patch together income from multiple streams and sources. Low-cost checking accounts then can become pitfalls and traps as overdraft and insufficient fund fees mount. Many households then turn to alternative, high-cost, and often predatory financial services to meet their banking needs. There's a great project done called the U.S. Financial Diaries Project, where they found what participants in the study most valued from a financial institution was a trusted relationship. No specific innovation or product. Gallup research found that those customers who said they strongly agree that their bank looks out for their financial well-being, on average had more products with that bank. That also leads to better outcomes for the bank. Although they used products, what participants in the project sought most was guidance and advice. The trust they sink is not simply in the institution, but also in their own ability to use the products. An interesting fact was that technology alone was not the answer. People felt there were already many, and often too many, technological options, and doubted their ability to sift through the details and implications of each. Similarly, although participants regularly accessed information online about their financial situation, they rarely felt comfortable making decisions on their own through the web or the mobile banking app. And all this is going on at a time when the bank branch is slowly but also increasingly being made obsolete. Another potential barrier is negative information from checking account reporting companies, such as Check Systems, Early Warning, and Telecheck. Banks and credit unions use reports developed by these companies to decide if someone can open a new account. You may have negative information in your file if you've had an account before and have an unpaid negative balance on that account, such as an overdraft. And the financial institution was forced to close that account, called an involuntary closure. If you were suspected of fraud, or if you had a joint account with someone else who had these types of problems. So Check Systems was created in 1991 as an electronic database of any consumers who have had an account closed on them by a financial institution. Now, on paper, an organization like Check Systems makes sense. Prior to 1991, if, for instance, I'm just using these off the top of my head, not indicting these banks or credit unions, if I went to Fifth Third, opened an account, ran it up, overdrafted it like crazy, and then went down the street to PNC and tried to do the same thing, I could do it because the banks and credit unions did not communicate about their customers. But now with Check Systems, PNC could run my name and see, oh, Joey ripped off Fifth Third. We don't want to work with him. Most financial institutions will check a database like Check Systems before opening an account for a consumer. Again, this was primarily meant to capture people committing fraud, but unfortunately, over the years, it's capturing many people who simply fell behind on their account due to that vague definition listed above. Anyone who goes in Check Systems has had an account closed on them by a financial institution. This could be someone who just fell behind $50 and couldn't afford to catch up. Many in the database are there due to overdraft, inactivity, and unsettled balances. The only way to remove yourself from Check Systems or these databases is to resolve the issue or find an institution that'll work with you. Most, though, will not work around fraud of any kind. Some banks and credit unions actually require you to pay those old charges and fees before you're allowed to open a new account with them, even if the fees are from a different institution. Under federal law, checking account reporting companies must, among other things, take steps to assure that the information is accurate. They cannot include most negative information that's more than 7 years old. In practice, some of these companies disregard information once it's 5. So what fee or account requirement is usually the main source of hassle and frustration for customers? What do you all think? What fee or account requirement? What do you all think is the thing that causes most consumers the most headache? We got a service fee. We got overdraft. Let's see. It is the overdraft fee. About 30% of all checking account holders are hit with overdraft fees over the course of a year. This was according to a 2014 report by the Consumer Financial Protection Bureau. The median overdraft fee, according to that same report, is $34. Monthly costs for overdraft and non-sufficient fund fees average $5.21 per person. That's compared with $1.66 for ATM and account use fees and $1.28 for average monthly maintenance fees. Consumers have an average of about 2 overdrafts per year, but in practice, a minority of bank consumers, about 18%, account for the majority of total overdrafts. This group tends to make less than the national median income, and for them, paying overdrafts can mean the equivalent of pretty much losing a week's worth of pay. The average cost of monthly maintenance fees, ATM and account fees, and overdraft and non-sufficient funds for a checking account is nearly $1,000 over a decade. It's around $10 to $12 for the most basic checking account at the biggest U.S. banks. Your bank can charge you for withdrawals at ATMs that are out of its network, with about $2.01 being the average fee nationally. So what happens to people without access to bank accounts when they need to access their paycheck? Where do the low income go for money products and services, if not financial institutions? Well, these places: the payday lenders and the check cashers. For those without access to a bank account, payday lending and check cashing can lead them right into a predatory trap. According to the FDIC, roughly 9 million households are unbanked. The alternative financial services industry is big business, with an estimated 340 million transactions each year, costing customers about $13 billion annually. On average, a borrower takes out about 8 payday loans of $375 each per year and spends $520 on interest per each loan taken out. A Pew survey found 5.5% of adults nationwide have used a payday loan in the last 5 years. In the past 2 years, 11% of U.S. adults say they've taken out one, according to CNBC. So what is a payday loan? Well, it's a short-term loan usually lasting up to 2 weeks. That is when a full payment is automatically withdrawn from a customer's bank account, plus a fee. In Kentucky, a payday lender can charge no more than $15 per 100 in credit for a loan. State law also restricts borrowers to no more than 2 loans at a time, or a cumulative $500 cap. While Kentucky law limits annual interest rates on financial products, like loans and credit cards, to a 36% interest rate, payday lenders are exempt. Payday loans are generally 14-day cash advances that cost between $15 and $30 per $100 borrowed, and range in size from 100 to 1,000, with about the median being 350. In addition to interest rates that typically exceed 400%, payday loans can trap consumers into rolling over the same debt multiple times. The Center for Responsible Lending estimates that more than 75% of all payday loans are rollovers of previous ones. So I need some contestants for The Price is Right. I need guesses. What do you all think is the average interest rate on a payday loan in the state of Kentucky? Give me some guesses. What do you all think is the average interest rate on a payday loan in the state of Kentucky? I see 40, 5.9, 25. Anybody else? I got 29. Let's see who was closest. The average payday loan interest rate in the state of Kentucky is 315%. So the closest was 40. Remember, they're exempt from the 36% rate that the banks and financial institutions are regulated to. They're exempt from it. So the average interest rate on a payday loan in the state of Kentucky is 315%. I saw some OMGs and goshes in the chat. Please keep this in mind. That's the average interest rate. So with any average, that means there's lower, and sadly, there's higher. As of 2016, the average borrower in the state paid $591 in interest and fees on an average loan of $341. The average Kentucky payday loan customer takes out about 10.5 loans a year and is indebted over 200 days a year. In 2014, Kentucky payday lenders took in $122 million in fees. They need to try harder. That seems like there'd be a ton more money for these interest rates. National figures, as I mentioned earlier, put the average yearly cost of payday lending at $800 per year, and $40,000 in fees and interest rates over a working lifetime. So to give you some demographical research, most payday loan borrowers tend to be white, female, and between 25 and 44 years old. However, after controlling for other characteristics, there are 5 groups that have a higher odds of having used a payday loan. That is those without a 4-year college degree, those who rent, African Americans, those earning below $40,000 annually, and single, those who are separated or divorced. It is notable that while lower income is associated with a higher likelihood of payday loan usage, other factors can be more predictive. For example, low-income homeowners are less prone to using them than higher-income renters. Here's your map of the interest rates in the United States. If you ever need a fun fact, Ohio currently has the highest payday loan interest rate in the U.S. Oh, it hurts to say this, with an average interest rate of 667%. Whew. You know, you wonder if there are no caps on some of these, why don't they just go into 1,000? Just, go ahead and hit 4 digits. Something interesting is most borrowers use payday loans to cover ordinary living expenses, not unexpected emergencies. The average borrower is indebted about 5 months of the year. Close to 80% of loans are renewed within 14 days, leading to the so-called debt traps. Payday loans are often characterized as short-term solutions for unexpected expenses and emergencies. Survey respondents from across the spectrum clearly indicate that they are actually using the loans to deal with regular, ongoing living expenses. 69% used it to cover a recurring expense, like utilities, bills, rent, or food. Only 16% used it for that unexpected emergency. So this may make it seem like more of an income issue than a banking issue, right? But what about a low-dollar loan from a financial institution? Well, the problem is there's got to be some down there. And those can take time. Whereas a payday loan, you can just walk in and get one of those. 58% of payday loan borrowers have trouble meeting monthly expenses at least half the time. These borrowers are dealing with persistent cash shortfalls rather than those temporary emergencies. Only 14% of borrowers can afford enough out of their monthly budgets to repay an average payday loan. But the average borrower can afford to pay the $50 per 2 weeks to roll it over. The choice to use payday loans is largely driven by unrealistic expectations and by desperation. Borrowers perceive the loans to be a reasonable short-term choice, but express surprise and frustration at how long it takes to pay it off. A majority of borrowers say payday loans take advantage of them, but a majority also say they provide relief. The appreciation for urgently needed cash and friendly service conflicts with their feelings of dismay about the high cost and how long they're in debt. If faced with a cash shortfall and payday loans were unavailable, 81% of the borrowers say they would cut back on expenses. Many would just delay paying bills or rely on friends or family or try to sell a personal possession. The options selected the most often, though, are those that do not involve a financial institution. So a quote from the director of the Pew Charitable Trust. It's normal to get caught in a payday loan because that's the only way they work. A lender isn't profitable until the customer has renewed or reborrowed the loan somewhere between 4 and 8 times. There are 537 active check cashing licenses registered with the Department of Financial Institutions in the state of Kentucky, most of which offer some kind of small dollar short-term loan, like a payday loan. Cash Express, the largest payday lender in Kentucky, operates 172 storefronts in almost every county. There are 578 payday lenders in Kentucky, which means there are more places to take out a payday loan than there are McDonald's in the state. And I don't know which one of those would depress me more. That's not a good stat either way. By almost a 3-to-1 margin, borrowers favor more regulation of payday loans. In addition, 2 out of 3 borrowers said there should be changes to how they work. Despite these concerns, a majority would use them again. Payday lenders, well, they say they're filling a gap left in low-income areas that are underserved by financial institutions. In states that enact strong legal protections, well, unsurprisingly, the result is a large net decrease in payday loan usage. Borrowers do not seem to be driven to seek these loans online or from other sources. In states with the strongest regulations, less than 3% of adults report using one in the last 5 years. By comparison, overall loan usage is 6.3% in moderately regulated states and 6.6% in states with no regulation. In states where there are no stores, just 5 out of every 100 would-be borrowers choose to go online. Which it blew my mind that you can take out a payday loan online. I didn't even think that was possible. A CFPB rule, which among other things would obligate lenders to confirm that people can actually afford to repay these loans, was set to go into effect in January. This was January of 2019, but was put on hold by the interim head of the CFPB. The new rule would have been the first major federal regulation of the industry. Mick Mulvaney, the interim chief who suspended that rule, also dropped a lawsuit against 4 payday lending companies in Kansas, accused of charging interest rates of nearly 1,000%. That same month, he ended an investigation into the marketing and lending practices of World Acceptance Corporation, one of the nation's largest payday lenders, and ironically, a donor to Mulvaney's previous congressional campaigns. In the past, the task of reining in small dollar lending has largely fallen to state legislatures. 15 states have essentially blocked payday loan abuse by capping rates at a low level or enforcing other laws. Advocacy in the state of Kentucky for reform has been spearheaded by a broad coalition known as the Kentucky Coalition for Responsible Lending. The coalition has been pursuing a 36% usury limit to payday loans, and this has been introduced in the General Assembly several times over the last 10 years. 2019 did see a permanent moratorium on any new payday lending licenses being issued, though those currently with one can still operate. This is because there's a strong payday lending lobby in Frankfurt, which at one point counted among its members a future Governor Bashir. Not Andy, his father. Research from the FDIC shows that there are many reasons consumers lack a basic transaction account. They may not have enough money for the minimum balance. There may be a distrust of financial institutions, and this can be on a generational level. If you're working with a client, all it takes is one family member who is having a negative interaction with a bank or credit union. They're the high or unpredictable fees. And then you can have ID, credit, or banking history problems. And without a checking account, families wind up paying too much for basic financial transactions and are hard-pressed to build assets. Many alternative financial services customers, they don't trust banks. They don't feel welcome. They don't understand the products they offer, and they can't afford the steep fees. For debit cards, the typical overdraft fee of $34 is triggered by an average of just $17. According to a report by Pew, the median extended overdraft penalty fee at the nation's 12 largest banks has increased 32% since 2010. So why do you all think financial institutions may be hesitant to locate in low-income communities? Why do you all think? It's not profitable? They don't get paid as much? Yeah, those are 2 great guesses. Any other guesses? You hit one on the head perfectly, which is the return on investment or profitability. And then they're also, they believe there will be security cost as well. So the flight of the banks not only means that the poor must now pay more for financial services, it also means their communities are losing the institutions that promote assets and promote savings. Fringe services also tend to have their finger on the pulse of low-income communities. Surveys suggest that customers are satisfied with these services they receive. They include convenient locations, flexible hours, other services you can get there, such as bus passes and lottery tickets, and perhaps most importantly, immediate access to cash. Generational beliefs about banking can also be an issue. Many families who are unbanked may be so by choice due to a family member in the past who had a negative experience with a bank. This can create an impact where future generations fear working with banks because of that previous person's experience. This is especially true for historical and cultural reasons. So a service out there, a resource you can use is Bank On Louisville. Kind of mentioned them earlier. Bank On is a national initiative of more than 90 coalitions to help curtail the use of fringe alternative services like the payday lenders and check cashers. Bank On Louisville is an engine to collaboratively strengthen our community's economic well-being through improved access to mainstream financial education and services, with an emphasis on the low to moderate income population of our city. Start Fresh is our main educational tool. It goes into the difference between banks and credit unions, the difference between checking and savings accounts, why you need a bank account, explaining certified accounts, which I'll explain here in a second, using certified accounts with a focus on digital and mobile banking, and some information on savings tools, tips, and resources. We offer Start Fresh monthly, open to the public and by request. It's offered virtually, and we offer it midweek, usually 10 a.m. to noon, and we can train people to facilitate it as well. So I mentioned the certified accounts piece. This is due to what are called the National Account Standards. So as I mentioned, Bank On Louisville was part of a nationwide initiative to get people reconnected to financial institutions. 2015 saw the nationwide initiative get a facelift, with the CFE Fund and Chase Bank funding the Bank On 2.0 project to standardize the movement. The focus was around the formation and push for national account standards, which are safe and affordable features that Bank On financial institution partners should be aspiring to offer to Bank On clients. The national account standards provide local programs with a benchmark for safe, affordable account partnerships with mainstream financial institutions. It is not mandatory for a partnering institution to offer an account that matches all these criteria, but it is recommended. The criteria identified in the standards is meant to address what is believed to be the biggest obstacles and issues for low-income consumers in managing a bank account. This focuses on functionality, affordability, and safety. The basis of any certified account is the lack of an overdraft possibility. This is primarily achieved by each certified account being checkless, meaning checks will not be a feature on the account. The other required features are a low minimum opening deposit of $25 or less, a monthly maintenance fee that has to be $10 or less, and if it's more than $5, it has to be waivable. There are no overdraft or hidden fees. You have to have a low ATM fee for outside of the network. And here you have a comparison chart for the certified accounts in our local Louisville area and their different fees and options. Our local accounts are offered by Old National, Chase, Truist, PNC has 2 options, US Bank, Citi, and the most recent was Fifth Third. Bank On also offers classes on credit building and youth financial education. You can learn more at bankonlouisville.org, or you can contact me. I'm the best contact for that. So wrapping up, banking is reaching a crossroads where technology is not only infused in the banking world, but beginning to take over. Every new advancement in the banking world takes us one step further removed from the brick and mortar branch and the teller. These advancements can help with issues of access, but studies show that those who need access, well, they actually prefer physical locations. Those stuck in check systems may be forced to utilize alternative fringe products to access their money. Even those not stuck with banking issues may be forced to utilize fringe products due to the lack of branches in their community. But Bank on Louisville and Bank on Nationwide Initiative can assist those stuck in a negative banking situation to kind of help get out of it. So wrap up, any questions? I also want to thank you all for attending. There will be a post survey and an email coming out later today with the presentation. If you need confirmation of attendance, please email me. I know some of you are here for the EAF, External Agency Fund requirement. If you need that confirmation, just email me. Our next certification class offering is on youth personal finance on November 11th from 10 a.m. to noon. You can register at cnpe.org. And for questions, comments, or concerns about the certification program or Bank on Louisville, there is my contact information. I will leave this slide up. Thank you all again for attending today. You are free to head out.